In 2023, a study by the Consumer Financial Protection Bureau found that roughly 40% of Americans who actively pay down their credit cards each month still carry a lower credit score than their payment behavior should produce. Not because they are doing anything wrong, because they are doing the right thing at the wrong time. You have probably felt this. You pay the bill in full, maybe even a few days early. You check your score a week later, and it has dropped 26 points. No missed payment, no new debt. Just a number moving in the wrong direction for no visible reason. Here's what that feeling actually is. It is the gap between when your balance gets recorded and when you get the chance to pay it. That gap has a name and a specific date attached to it. Most people have never heard of it. That is what this video is about. If you do not know this date exists, your score keeps telling a story about you that stopped being true 3 weeks ago. And lenders make decisions based on that version, not the real one. My name is Alex. And if you have ever paid your card on time and still watched your score drop, stay with this. Because the scoring system is not measuring what you think it is. And I'm going to show you exactly where your score is actually being set and how to make sure the number lenders see reflects what you actually do with money. Once you understand this, you will stop reacting to your score and start managing it. The reason this keeps happening traces back to how your credit score is built in the first place, and 2 of its 5 components do almost all of the work. 5 factors. That is all your credit score is. 5 inputs, run through an algorithm, compressed into a 3-digit number that determines whether you get the mortgage, what interest rate you pay on the car loan, and sometimes whether you get the apartment at all. Most people treat that number like the weather. It changes, they check it, they feel vaguely anxious, and then they move on. But a credit score is not random. It is a formula. And once you know what is actually in the formula, the number stops feeling like something that happens to you and starts feeling like something you can influence. Here is how the formula breaks down. Payment history accounts for 35% of your score. That is the largest single factor. It is exactly what it sounds like. Do you pay your bills on time, every time? One missed payment, reported to the bureaus, can knock 40 to 100 points off your score, depending on where you started. That is not a rounding error. That is the difference between qualifying for a loan and getting turned down. The second factor is amounts owed, which makes up 30%. This one is more commonly known as credit utilization, and it measures how much of your available credit you are currently using. If your credit limit across all cards is $10,000 and your reported balance is $3,000, your utilization is 30%. Lenders generally want to see that number below 30%. The best scores tend to sit below 10%. Together, payment history and utilization make up 65% of your total score, nearly 2/3. The other 3 factors, length of credit history, credit mix, and new inquiries, split the remaining 35% between them. They matter, but they move slowly. You cannot meaningfully change your length of credit history in a month. You cannot improve your credit mix overnight without opening new accounts, which temporarily hurts your score anyway. Utilization is different. It can change completely within a single billing cycle. That is what makes it the fastest lever in the entire system. Think about what that actually means. A software developer earning $92,000 a year, paying every bill on time for 6 years, never missing a payment, never carrying a balance month to month, could still have a credit score 30 or 40 points lower than someone with a shorter history, simply because of how their balance looks on one specific day each month. Not because of their habits, because of timing. That is not intuitive. It feels wrong, actually. The system is supposed to reward responsible behavior, and this person is behaving responsibly. But credit utilization does not measure your habits over time. It takes a snapshot, one reading once a month, and that reading gets sent to the bureaus and locked in until the next cycle. Now, here is where it gets interesting. Of those 2 dominant factors, payment history is essentially fixed month to month. Either you paid on time or you did not. There is no strategy there beyond paying on time, every time. You cannot retroactively fix a late payment, and you cannot manufacture a longer payment history faster than the calendar allows. But utilization, that is fluid. That is the number you can actually move. A 2024 analysis by Experian found that consumers who actively managed their reported utilization, specifically those who reduced their reported balance before the reporting date rather than simply paying by the due date, saw an average score increase of 37 points within 60 days. No new accounts, no debt payoff, just a shift in when they paid. 37 points are not trivial. At a credit score of 690, you're looking at a mortgage rate that might be 0.5% higher than someone sitting at 730. On a $400,000 home loan over 30 years, that 0.5% is roughly $38,000 in additional interest. The utilization number on one day of the month connects directly to that outcome. And the reason most people never make this adjustment is not laziness. It is that nobody explains which date actually controls the reported balance. People learn about the payment due date because it is everywhere. On the bill, in the app, in the autopay confirmation email. It is the date that carries the penalty for missing it. The other date is quieter. It does not come with a warning. It does not trigger a fee if you ignore it. It just determines what the world sees when it looks at your credit file. Understanding that difference and knowing which date is actually pulling the strings is the whole mechanism this video is built around. And to see exactly how it works, you need to look at the two dates on your credit card statement side by side, because one of them has been running your credit score this whole time while you were watching the other one. Every credit card statement has two dates printed on it. Most people know one of them by heart. The other one is sitting right there on the same page, and the majority of cardholders have never once thought about what it actually controls. That is not an accident. One date comes with consequences you feel immediately: late fees, penalty interest, a ding on your payment history. The other date is quieter. It does not punish you for ignoring it. It just shapes what lenders see when they pull your file. And because nothing bad happens the day you miss it, most people never learn it exists until something confusing shows up on their credit report. Here is how the two dates actually work. The first is the payment due date. This is the one printed in large type on every statement. It is the deadline by which you need to pay at least the minimum balance to avoid a late fee and keep your payment history clean. Miss this date and the consequences are fast and visible. Your bank charges you. If you are more than 30 days late, the missed payment gets reported to the bureaus. Your score drops. The due date is a hard deadline with real penalties attached to it, which is exactly why everyone learns it. The second date is the statement closing date. This is the last day of your billing cycle. It is the moment the bank closes the books on that month, totals up everything you spent, and generates your statement. And here's the part that changes everything. The closing date is also the day your balance gets reported to the credit bureaus. Whatever your balance is at the end of that day, that is the number that goes into your credit file. That is the number that becomes part of your utilization calculation. That is the number a lender sees when they pull your report next week or next month, or the day you apply for a loan. The due date determines whether you pay interest. The closing date determines what the world sees. Those two things are completely separate, and the gap between them is usually somewhere between 21 and 25 days. That gap is where the confusion lives. Here is how this plays out in practice. A nurse working in Chicago carries a credit card with a $4,000 limit. She uses it regularly: groceries, gas, a few work expenses, and she pays the full balance every single month without fail. She has never paid interest. She has never missed a payment. By every behavioral measure, she is an excellent borrower. Her statement closes on the 14th of the month. Her payment is due on the 8th of the following month. So each month, around the 12th or 13th, her balance sits somewhere around $1,600. She charges a bit more over the next couple of days before the closing date hits. The statement closes with a balance of $1,940. That number gets reported. Her utilization on that card is just under 49%. The bureaus record it. Her score reflects a borrower using nearly half of her available credit, which, according to the scoring model, signals some degree of financial pressure, whether or not that is true. 3 weeks later, she pays the full $1,940. No interest, no late fee, perfect payment history. But the reported balance does not update until the next closing date. For that entire month, the number sitting in her credit file is 49% utilization, not zero. She is doing everything right. The score does not reflect that. This is the part that frustrates people when they first understand it. And honestly, the frustration is warranted. The system is not measuring current behavior. It is measuring a frozen moment in time, one snapshot per month. And that snapshot is taken before you have even had the chance to pay. A 2025 report from the Federal Reserve noted that average credit card utilization among borrowers who pay in full each month is still recorded at roughly 28% at the time of bureau reporting. not because those borrowers carry debt, because the snapshot is taken mid-cycle before payment. At every single time, the closing date is not hidden. It is on your statement, it is in your banking app if you know where to look, but it is never explained, never highlighted, and never connected to the score impact in any way that makes the mechanism obvious. The due date gets all the attention because missing it costs you money immediately. The closing date operates silently, shaping your credit profile month after month, whether you understand it or not. Once you see the gap between these two dates clearly, the solution becomes straightforward. You do not need to change your spending. You do not need to pay off your card faster than you already do. You just need to shift when the payment lands, specifically to land it before the snapshot is taken. That is the three-step play, and it is simpler than it sounds. Most credit advice tells you to pay more, spend less, or wait longer. This strategy requires none of that. The balance you carry does not change. The total amount you spend does not change. What changes is the single day you choose to move the money. And that one shift is enough to change what the bureaus see entirely. The nurse from the previous example is not doing anything wrong financially. She is doing everything right. She is just paying at the wrong moment relative to the snapshot. And the fix is not a financial overhaul. It is a calendar adjustment. Here is how it works, step by step. Step 1. Find your statement closing date. This is not the due date. It is the last day of your billing cycle, the date the bank closes the books and generates your statement. For most cards, it falls somewhere between the 1st and the 28th of the month, and it is printed on every statement you have ever received. If you have not looked for it before, open your last PDF statement and scan for the phrase closing date or statement period ends. It will be there. You can also find it in your bank's mobile app under account details or statement settings. Once you have that date, you have the only piece of information you need to make this work. Step 2. Pay down the balance a few days before the closing date, not the full balance necessarily. We will come back to why in a moment, but pay it down to somewhere between 1 and 9% of your total credit limit. If your limit is $4,000, that means leaving a balance of somewhere between $40 and $360 on the card before the closing date arrives. Timing matters here. Pay 3 to 5 days before the closing date, not the day before. Payments can take 1 to 2 business days to fully process and reflect in your account balance. If you pay on the 13th and your statement closes on the 14th, but the payment has not cleared yet, the bank still sees the higher balance. Build in a small buffer. That reported balance, the one the bureaus now record, is somewhere below 10% utilization, not 49%, not 30%, under 10. Step 3. Pay off the remaining small balance by the actual due date. This is the normal payment you are already making, just applied to a much smaller number now. If you left a balance of $80 before the closing date, you will pay $80 by the due date. No interest accrues on purchases if you pay the full statement balance. Your payment history stays clean. Nothing about your financial behavior has changed. Only the timing of when the larger payment hits. Run the numbers on what this looks like in practice. Take a project manager earning $87,000 a year. He carries 2 credit cards. Card 1 has a limit of $5,000, and he typically charges around $2,000 a month on it. Card 2 has a limit of $3,000, and he puts roughly $900 on it each month. Before he understood the closing date, both balances were sitting near their peak when the snapshot was taken. Card 1 was reporting around $2,000, 40% utilization. Card 2 was reporting around $900 with a 30% utilization. His blended utilization across both cards was around 36%. His score hovered in the low 700s. He made one change. A few days before each card's closing date, he paid each balance down to under $100. Card 1 reported $90, under 2% utilization. Card 2 reported $60, 2% utilization. His blended utilization dropped from 36% to just under 2%. His score moved from 708 to 761 in a single billing cycle. 53 points, same income, same spending, same cards, different timing. At 761, he qualified for a mortgage rate that was available to him at 708, just at worse terms. The rate difference was 0.4%. On a $380,000 loan, that difference is just over $31,000 across the life of the loan, saved by moving a payment forward by a few days. The mechanics here are straightforward. but executing them consistently requires one small habit shift. Your current autopay, if you have it set up, is almost certainly pointed at the due date. That setting will not do what you need it to do. The early payment before the closing date has to be made manually, at least until you build the routine. Set a recurring reminder on your phone for 4 days before each card's closing date. When it fires, log in, check the balance, and pay it down to that small reported number. The whole process takes about 3 minutes. That is the mechanism. Clean, repeatable, and entirely within your control every single month. But knowing the 3 steps is only part of the picture, because there are a couple of common traps that can quietly undermine this strategy, and one of them catches people exactly when they think they have it figured out. Getting the strategy right is one thing. Avoiding the mistakes that quietly cancel it out is another. And there are 2 failure modes here that are easy to miss, not because they are complicated, but because they look, on the surface, like the logical next step after learning everything in the previous section. The first one trips up people who have just discovered the closing date strategy and immediately think, if a low reported balance is good, then a 0 reported balance must be perfect. It makes complete sense as an assumption. You have been paying down to 1% or 2% utilization, your score has climbed, and now you are wondering why you're leaving anything on the table at all. Why not just pay the entire balance to 0 before every closing date and report nothing? Here is why that logic breaks down. Credit scoring models do not just measure whether you use credit responsibly. They measure whether you use credit at all. A borrower who reports a 0 balance month after month across every card starts to look invisible to the algorithm. Not trustworthy. Invisible. The system cannot assess how you manage debt if there is no debt to observe. And invisibility, in credit scoring terms, gets penalized. This is sometimes called the ghost borrower problem. FICO scoring models are designed to evaluate active credit behavior. A reported balance of 0 on every account, sustained over multiple months, can actually suppress your score by several points, compared to reporting a very small balance. The algorithm interprets consistent 0 balances as a signal that the card may not be in regular use, which reduces the behavioral data the model has to work with. The practical fix is simple. Before each closing date, pay your balance down to somewhere between 1 and 3% of your credit limit, not to 0. On a $5,000 limit, that means leaving between $50 and $150 on the card. That small reported balance tells the scoring model that the account is active, that you are using credit, and that you are managing it well. It is the difference between a score that reflects responsible use and a score that reflects no use at all. 1% is the sweet spot most credit analysts point to. It is low enough to keep your utilization score near its ceiling. It is just enough to keep the account looking alive. The second trap is more behavioral, and it has a specific name that banks take seriously: credit cycling. Here's how it tends to happen. Someone learns about the closing date strategy, starts paying down their balance early each month, and then notices something. By paying off most of the balance mid-cycle, they have freed up available credit again before the month is over. They start spending against that freed up credit, paying it down again, spending more, paying again, effectively resetting their available balance multiple times within a single billing cycle. This feels like a clever workaround. It is not. Banks monitor transaction patterns, and cycling through your credit limit more than once in a month is a recognized red flag. It signals either financial stress, someone spending beyond their means, and repeatedly clearing the balance just to keep spending, or an attempt to obscure actual utilization levels from the bureaus. A 2025 review of credit card account closures by the Consumer Financial Protection Bureau found that credit cycling was among the top behavioral triggers for involuntary account closures and credit limit reductions. Banks do not send a warning before taking action. The account is open. The next month, the limit is cut in half, or the account is closed entirely. Either outcome immediately damages your credit profile. A lower limit means higher utilization on any remaining balance, and a closed account reduces your total available credit across the board. The rule of thumb is straightforward. Pay your balance down before the closing date, once per cycle. Spend normally for the rest of the month. Do not chase the freed up credit limit mid-cycle as if it is additional spending room that has been unlocked. It has not been unlocked. It is still the same limit, and treating it like a revolving door is exactly the behavior the bank's risk system is watching for. Think of it this way. The strategy works because you are timing a single payment to land before a single snapshot. That is all it is: one payment, one date, one reported number. The moment you start making multiple payments mid-cycle to manufacture spending capacity, you have left the strategy behind and entered territory the bank reads as risk. Stay in the strategy. Pay once, early, and leave the small balance. Then let the closing date do its job. Those are the two rails this runs on. Report a small balance, not zero, and a never cycle the credit limit within a single month. Get both of those right, and the system works the way it is supposed to. And that brings everything together into the one shift that connects all of this. The idea that your credit score is not a verdict handed down to you, but a story being told about you, one snapshot at a time. Here's what this all comes down to. Your credit score is not a judgment on your financial character. It is a monthly photograph. And like any photograph, what matters is not just the subject. It is the moment the shutter fires. You can pay every bill on time, never carry a balance, and still watch your score underperform simply because the snapshot was taken before you had the chance to pay. That is not a flaw in your behavior. It is a flaw in the assumption that the system measures what you think it measures. The mechanism is worth keeping. Utilization moves fast, payment history moves slow, and the closing date, not the due date, is the number that gets reported. One small balance beats zero. One early payment beats perfect timing on the wrong date. The question worth sitting with now is this: it's if a 37-point score improvement is possible just by shifting when a payment lands. What else in your financial life is being measured at the wrong moment and quietly working against you without any visible signal that something is off? If that question interests you, subscribe. The next video goes there.